I know some of you may be wondering, why are you talking about WeWork again? Aren't you supposed to talk about things that are tradable? And in general, yes. But I find this story so fascinating and with so many ramifications about investor behavior and broader risks to the economy that I just can't resist it. Let's unpack some of the more recent developments. Remember that WeWork was sold some shares with a valuation of $47 billion in its last private round of financing, and it very nearly came public at a valuation, well, starting to approach that level, and then as more information was revealed, the valuation kept going lower and lower. And it's questionable now, with all the information that's come out, whether let's say if it had come public, probably would be down. I've seen someone estimate about 80%, and that's probably not a bad guess. This thing, the more that we learn, the worse it looks. And I'm not going to go into the past misdeeds because that's really company specific in a way that doesn't apply. But there are several lessons here. First of all, sunshine is a good thing. This company was operating more or less in secret. Private companies have the right to do so. But it's amazing to me that sophisticated investors, whether it was SoftBank or any of these other big capital allocators that put in money in subsequent rounds, makes me wonder what did they see that the rest weren't? Was there some sort of collective madness going on almost? Because there was a great story, but as I looked at it from day one, I always said, this is just a big subletter. I don't get it. So that's always something that makes me wonder, like, what was going on in market psychology that allowed this thing to happen? And I guess in that sense, it's probably a good thing if markets came to their senses regarding giving money to businesses that don't appear to make money and don't appear to have a way to make money. So that's a healthy thing. Another one is WeWork, essentially their business model is they take long-term leases and provide short-term leases and hope to profit on the spread. That's essentially what banks do in some ways. They make long-term loans and borrow short-term, using, although they don't pay you much interest on your savings or your checking, you can withdraw that money at any point. But that also got banks into huge trouble in the 80s and part of them, and sometimes in the 90s, because they were mismanaging their timing on loans. Basically, you need great risk management if you're gonna lend long and borrow short, or tie yourself up in long-term assets, and rely on shorter term transactions to pay for that. And considering the scale that WeWork was doing it, that's an enormous amount of risk. You have to wonder, what did they see the potential addressable market as being? So that's a risk, and that's always just something to keep in mind. If you see a funding mismatch, if you see an asset and liability mismatch, that's often a big flag. Another one is, the cult of the unicorn, and it's very important to realize what's going on. And I do think this actually has very negative ramifications for SoftBank, and that is a lot of things got called tech companies. Uber was a tech company. They're a ride-hailing company. Yes, they do have the technology going on about self-driving cars and stuff, but for the most part, their business is taxi cabs. WeWork is a subletter. These are businesses that require that as you grow, there's not necessarily economies of scale. And I think that calling them tech companies just because they had a tech overlay on a basic business doesn't make them a tech company. What makes a tech company different and often special, and which is why they often have great valuations, are they have tremendous operating leverage. If you develop a piece of software, there's an awful lot of fixed costs that go into it. You're paying for the developers. You're building this piece out. But once you start selling it, the marginal cost is relatively low, almost can be almost zero. So the operating leverage is tremendous. That's an advantage that biotech companies have and software companies have, and let's call them real technology companies have, because there's all this fixed costs that go in, but your marginal cost at the end can be huge, your marginal profits. There's a lot of risk in that, by the way. That's particularly if you're in biotechs, you realize that it's very easy to have your stock cut in half. But That's what I want people to focus on is the differing business models, asset liability mismatches, and kooky investor behavior.